Welcome to this YouTube channel. In this video we are going to talk about how countries create money. So before starting this video, like this video and subscribe to our YouTube channel for future updates. Money creation, often known as money issuance, is the process of increasing a country's or an economic or monetary region's money supply. In most modern economies, private banks create the majority of the money supply in the form of bank deposits. Central banks measure monetary aggregates known as broad money, which include cash and bank deposits, to keep track of the amount of money in the economy. When the number of monetary aggregates rises, money is created. Base money is the money issued by central banks. By engaging in open market activities, central banks can directly increase the quantity of base money. Commercial banks that use fractional reserve banking extend bank loans to increase the quantity of wide money beyond the amount of base money issued by the central bank. Governmental entities, such as central banks and other bank regulators, can influence the quantity of broad money issued by commercial banks by regulations such as reserve requirements and capital adequacy standards. The central bank of the country is the institution in charge of monetary policy. A central bank's mission often includes one or more of the three purposes listed below, in descending order of preference, depending on the country or region: price stability, I.e. inflation targeting, maximum employment facilitation in the economy, and the provision of moderate long-term interest rates are all goals. The central bank serves as the government's banker and provides a variety of operational services to the government, such as handling the Treasury's single account and acting as its fiscal agent, for example, by conducting auctions, settlement agent, and bond registrar. In its own currency, a central bank cannot go bankrupt. A central bank, on the other hand, can become insolvent due to foreign currency liabilities. With a few exceptions, central banks operate in almost every country on the planet. There are some groups of countries for which a single entity acts as their central bank through agreement, such as the Central African Organization of States, which all have a common central bank, the Bank of Central African States, or monetary unions, such as the Eurozone, where nations retain their own central banks, but submit to the policies of the central entity. The European Central Bank, the government's executive branch, is largely autonomous of central banking institutions. To meet the needs of commercial banks for cash withdrawals, and to replace worn and/or destroyed currency, the central bank or other competent state agencies, such as the Treasury, are normally empowered to manufacture new physical currency, i.e. paper notes and coins. The technique does not raise the money supply in the traditional sense. Hence, the term printing new money is a misnomer. Physical cash accounts for a small portion of the wide money supply in modern economies. This is how nations generate money. The Federal Reserve is the United States Central Bank, and it is perhaps the world's most powerful economic institution. The management of the total outstanding quantity of US dollars and dollar substitutes is one of the primary responsibilities outlined in the Federal Reserve's, commonly known as the Fed's, charter. The Federal Reserve is in charge of policies that produce or destroy billions of dollars on a daily basis. Despite its responsibility for managing the money supply, the modern Federal Reserve does not simply print new paper dollars. The United States Department of Treasury still prints some real dollars. But the great majority of the American money supply is digitally debited and credited to big banks. After the banks have loaned out those new balances to the broader economy, real money is created. The Federal Open Market Committee, FOMC, and its accompanying economic advisors meet on a regular basis to examine the United States money supply and overall economic situation. If it is determined that fresh money is required, the Fed sets a specific level of money injection and implements a policy to match. Because many things might be described as money, it's difficult to keep track of the actual amount of money in the economy. Savings accounts and checking accounts indicate direct and liquid money balances, and paper bills and metal coins are obviously money. Money market funds, short-term notes, and other types of reserves are frequently counted as well. The Fed can only approximate the money supply, though. The Fed may launch open market operations, or OMOs, in which it buys and sells treasuries to inject or absorb money. For interim expansions, it can use repurchase agreements. It can use the discount window to give banks short-term loans. Increases in bank reserves are by far the most prevalent outcome. So, if the Fed wishes to pump $1 billion into the economy, it can simply create $1 billion of new money and buy $1 billion worth of treasury bonds in the market, according to the type and size of the account in which the instrument is maintained. The various forms of money in the money supply are commonly categorized as MS, such as M0, M1, M2, and M3. Not all of the classifications are frequently used, and different classifications may be used in different countries. The money supply indicates the many types of liquidity available in the economy for each type of money. It is divided into various liquidity or spendability categories. Money aggregates are a statistic used by the Federal Reserve to assess how open market operations, such as Treasury securities trading or adjusting the discount rate, affect the economy. Investors and economists pay special attention to the aggregates because they provide a more accurate picture of a country's working money supply. Investors can measure the money aggregate's rate of change and overall monetary velocity by evaluating weekly reports of M1 and M2 data. Money creation was a physical reality in the early days of central banking. New paper notes and metallic coins would be manufactured, embossed with anti-fraud devices, and then given to the public almost invariably through a politically connected government agency or corporation. Since then, central banks have gotten far more technologically innovative. Money does not have to be physically present to work in a transaction, as the Fed discovered. Checks, debit and credit cards, balance transfers, and internet transactions are all options for businesses and consumers. The central bank can just envision new dollar balances and credit them to other accounts. Thus, money production doesn't have to be tangible. A modern Federal Reserve creates new liquefiable accounts, such as U.S. Treasury bonds, and adds them to existing bank reserves. To receive these payments, banks typically sell other monetary and financial assets. This achieves the same results as printing new bills and transferring them to bank vaults, but at a lower cost. It's just as inflationary. And newly credited money balances have the same weight in the economy as actual dollars. Assume the U.S. Treasury produces $10 billion in new bills, and the Federal Reserve credits another $90 billion in easily liquid accounts. At first glance, it may appear that the economy has gotten a $100 billion infusion, but this represents only a small portion of total money production. Because of the function of banks and other lending organizations in receiving fresh money, this is the case. Almost all of the extra $100 billion goes into bank reserves. Even though the Fed currently pays banks 0.25% interest to simply park their money with the Fed bank, banks don't just sit on it. The majority of it is lent to governments, enterprises, and individuals. The credit markets have evolved into a money distribution channel. New loans, on the other hand, create even more new money in a fractional reserve banking system, with a legally mandated reserve ratio of 10%. The increased $100 billion in bank reserves might result in a $1 trillion nominal monetary rise. The central bank creates monetary reserves and distributes them to commercial banks in the modern banking system. Banks can then lend a large portion of that money, up to a specified level known as the reserve requirement, which in the United States has been approximately 10%. So, if the Fed gives a bank $1 billion in reserves, it can lend $900 million to borrowers. These borrowers will then deposit those funds back into banking systems, either directly or indirectly via persons who have been paid with the loaned money, which can then be loaned out at a rate of 90%. So if $900 million is deposited, an additional $810 million might be deposited. The $1 billion in reserves will eventually transform into $10 billion in new credit money in the economy, because to the money multiplier effect. What do you think about this video? Do let us know down in the comments section below. If you enjoyed this video and want to hear from us again, be sure to hit that subscribe button before you go.